The tech
The
reversal?
tech reversal, is it
Yeah,
likely
so
to be sustained?
the way we see that is that we are going through a period of consolidation in overall Asian equities. And this is a combination of the fact that risk reward is just extremely unattractive. If you look at valuations, they're very stretched. Sentiment is quite optimistic. And we are starting to see positioning that is no longer as light as it used to be. Add on top of that, that we've already passed much of the earnings results that we were expecting to be quite good, especially in the US. And we are also seeing a reversal in the dollar weakness, which has been a tailwind for Asian equities. So you put this all together, you start to see that the risk reward is starting to get quite poor. And with macro momentum slowing down, as we are seeing in all of the data that's coming through, it makes for a bit of a consolidation in Asian equities. Then on top of that, now we are starting to get the US-China political frictions. And this is definitely a downweight for the tech sector in the near term. That having said, we do like the sector and growth stocks and quality stocks overall on a medium-term perspective. We do think that many of the outcomes of the COVID crisis will essentially be very good for these growth stocks and quality stocks. So tech, healthcare among those there.
You know, Mixo, some say forget the tech risk, because when you take a look at Asian stocks, they're trading at about 25 times estimated earnings versus 34. When you take a look at their peers in the U.S., that could be more upside.
Correct. Yeah. So again, if you look at Asian equities overall, right, or emerging market equities compared to their developed market peers, they're definitely trading at a pretty large discount. And even if you adjust for the differential in growth expectations that has occurred between these two regions, you still find that EM equities, Asian equities overall trade at a discount. This is true for almost every sector. And again, if you think that the Asian tech peers are on a similar trajectory as we have seen in the US, then the valuation argument becomes quite compelling for owning Asian tech relative to US tech. So I would be definitely on that trade.
But Mixo, if the U.S. is actually trying to ban communications or shut down communications on a tech player like Tencent in the U.S., I have to wonder, is it more than just sentiment? Is there actually a threat to earnings now? You're essentially shutting down millions of dollars of transactions between the U.S. and China. Does it have more of a material risk?
Yeah, so the way we think about this, the latest announcements from last week is that there's three parts to this, right? First, in the very near term, is just a sentiment shock, and we've probably seen already most of that. Some of these affected stocks were down up to 10% or more on Friday itself. From there, we do see the opportunity to buy on weakness, because the second half outlook for many of these stocks remains very, very compelling on a fundamental basis. So we do see opportunities for investors to add positions here. But that having said, the third thing, and the point that you make, is also that on a longer term basis, on a multi-year basis, there is some earnings downgrades coming for the like, especially on the gaming side, where much of the future expectations of growth for these companies were coming from international revenues. And now that channel is a little bit under question.
Yeah, and you mentioned a little bit about the earnings season that we've been underway right now. So far, we've seen quite a wide gap between the work from home winners versus the cyclical stocks here. Do you expect that to actually narrow a little bit more, or could it actually widen further?
Right. So this is quite interesting, because if you think back to the whole year of 2020, given the way the macro has developed and that we have seen a very, very large correction in the course of this year, you would have thought that momentum as a style would have done pretty poorly and value as a style would have done quite well. But obviously, the actual result is exactly the opposite. And the big driver behind that is COVID. So all of this work from home, stay at home beneficiaries have been in the momentum camp, and they have sustained their rallies and outperformance relative to what's been on the other side of banks, industrials, commodity plays, which have been more on the value side. And this is very atypical of a large correction and recovery thereafter. Now, where we see going forward is that there is room for a bit of a consolidation in the momentum players and a bit of correction in the momentum style and some tactical rally on the value side. But the really large catalyst, which is going to be MMT, it's only going to come in next year once inflation and growth expectations start to rise sustainably, and that will drive the big rotation into value. So we're not quite there yet. Now we are just playing for a bit of consolidation on the momentum side, and this is going to be triggered by basically the COVID issues dying down a little bit. You can see the COVID new cases globally has been slowing down for a couple of weeks now, and that should eventually start to show through in some weakness in performance of the stay-at-home and work-at-home plays.